Firstly, we're advising our clients to do three things. On the fixed income side, absolutely still a lot of very attractive opportunities given where corporates are, given where munis are. You can lock in high single-digit rates. However, extending the duration is important to lock in some of those high single-digit rates. So we've been shifting portfolios to extend duration on the fixed income. On the equity side, it's interesting because we had an extraordinarily large rally last week, 6% as everyone saw on the S&P 500, bringing the year-to-date returns of 14+% on the S&P 500. But that's been driven by 7 tech names. So when you normalize for that a bit and you dig a bit deeper in the equity side, you can see a lot of value in small and mid-cap growth stocks. They're trading at a roughly 20% discount at the moment. In addition to that, emerging markets are also trading at about an 18% discount to developed markets. So the key there is to look at some interesting pockets of opportunity to diversify globally and also look at some names in important industries that we like for growth in the future. And the last thing we're advising clients is that they should continue to add into their alternative and private equity allocations. There's been a lot of dislocation in the market. Investors are much more willing these days to pay the illiquidity premium for potentially higher returns, and there's a lot of interesting market opportunities, obviously, there too.
I'll tackle the second point around stocks, if I can. The discount that you've highlighted around small and mid-cap growth stocks and EM. Why are they trading at a discount? What's trapping them at discounted rates at this point?
Well, they're attractive valuations is what we're seeing, right? So there's a lot of really interesting opportunities. We're seeing some particular areas of growth in technology. Of course, cyber is at the top of everyone's mind. Cyber, AI, robotics, continuing to be very, very attractive investment opportunities. Stocks in the healthcare space with the aging population and some of the innovation that we're seeing in healthcare is also very attractive. So pockets and industries of sectors that we think are ripe for continued growth in the future.
My point is, what's keeping them trapped in the range? Is it because of the macroeconomic environment, the high rate story?
It is.
Lack of positive sentiment? You know, what's the main element here that needs to change?
It's frankly both. Also, I think it's a little bit of weariness on the investors' part too. It's been a pretty challenging couple of years. You know, you've had we're coming off a really, really challenging market in the prior year. This year's been sort of up and down, and then couple that with the geopolitical risks that everyone is trying to navigate. The two wars that are happening at the moment, the bifurcation between China and the U.S. continuing to be very, very strained. So considerations around geopolitical risks.
You won't have missed the household debt and credit report from the New York Fed yesterday as well. When I look at stuff like that and I look at the increase in revolving credit, auto loans, etc., I see a consumer which is heading for a recession as well. And if we are heading for a recession in the part of the economy that dominates the US as well, how can we be buying stocks now rather than waiting? Because I mean, history will tell us that actually you don't buy stocks before the recession.
Right. You're right, absolutely. But interestingly, so we believe that we are at peak rates at the moment, right? We expect that rates will likely start to come down at midpoint or before midpoint next year, right? We're seeing the recession numbers coming down. We're seeing actually corporate profits improving and continuing to look quite good and solid into next year. So those are signals for us that we could see some rebound in the markets in the second half of next year and going into 25. So therefore, we don't want to sit on the sidelines
too long,
right?
But